Thanks very much for joining us this morning. This is a webinar on general legal accounting and tax updates. If we just move to the next slide, please. So this is for those of you that joined our previous two webinars. It's part of a 3-webinar series that we've been running. The first one was on PCNs, second one was on practice merger issues. Both those videos are now available online. And today's, as I said, we're covering legal accounting and tax updates. My name's Andy Pow. I'm from Mazars. I'm from the healthcare finance team in Mazars, and I'm going to be joined today by Sarah. Sarah, over to you.
Hi everyone, I'm Sarah Carr, an associate in the commercial health team at Mills and Reeve.
Excellent. So in terms, next slide, please. In terms of what we're going to cover today, so I'm going to kick off and cover some of the accounting and tax issues. So we're going to look at last week's autumn statement. That does have some quite significant impacts potentially on general practice. We'll have a look at something coming ahead, although it's catching up with us fairly quickly now, basis period reform. Talk a little bit about pensions and talk just a little bit about the inflation pressures. And then Sarah's going to cover some tricky topical issues to do with partnership changes and some other matters on powers of attorney and a heavily debated area of trust regulation rules, which has been going back and forward over the last few months. So she'll update us on that. So I'm going to kick off on the finance issues. So if we just move to the first slide, please. So yeah, last week we had the first autumn statement, well, the first budget from Jeremy Hunt. Hopeful, given his previous NHS sort of background, that it was going to be reasonably favourable for the NHS, but I don't really think it has been. I think he's been left with quite a tight budget to work with. In terms of sort of some of the key issues that are going to impact on general practice, I mean, firstly, one of the areas we were looking for some reform on was the pension annual allowance and lifetime allowance regime. Absolutely nothing was mentioned in the autumn statement on that. So the rules continue as they are, and the lifetime allowance is frozen now to 2025-26. We are expecting maybe some changes within the pension scheme rules to deal with the inflation aspect, which is going to cause some big issues in 22-23, but as yet nothing has been published. That was mentioned previously by Teresa Coffey. So it's really watch this space, and at the moment we just have to assume that the regime will continue as it is. The one thing that they did raise was the change in the 45% tax rate. So at the moment, 45% tax rate kicks in at £150,000 income above that. That's now being reduced to 125,140, which seems a strange amount, but that coincides with the point where the tax-free personal allowance gets phased out completely. So effectively, that means the 40% tax band now ends at £100,000 of earnings. So we will find that anyone earning above 100,000, and that's income less pension, will be subject to higher rates of tax going forward from 23-24. They did confirm that national insurance reversal has going through. So we had a rise in national insurance that came through in April 2022, and that will change back in November to the previous rates. So the previous 1.25% national insurance levy, which is really identified for social and healthcare, has been reversed. What they have done, though, is also freeze all the personal tax allowances and freeze all the tax thresholds that you pay tax on. That was previously frozen for the Parliament, but it's now been moved forward to April 2028. Although, of course, we could get a change of government by then, because there will be an election in that period. So it will be very much dependent on the new government coming in at that point in time. That, though, does result in effectively more taxation over the years, because by freezing the thresholds, it means if your earnings go up over that period, more of your income will be caught in higher rates of tax. And again, it applies to your staff as well, insofar as when they have their annual pay rises, that will also catch them as well. We have quite a sizable change in investment related activities. So at the moment we have a dividend allowance, which allows you to earn £2,000 in dividends tax-free. which is useful when you've got your own personal company, but also useful when you've got a portfolio of shares or any kind of investment which is receiving dividends outside of a tax-free investment like ISAs. At the moment it's 2,000. That's dropping to 1,000 in 23-24, and then £500 in 24-25. So a lot of people that haven't had to pay tax on dividends over the past few years will now find that they get caught. Likewise, the capital gains tax allowance, so each year you get an annual allowance of capital gains, which you can make, which is 12,300. That's going to drop to 6,000 next year, and then 3,000 in 24-25. So again, anyone who's disposing of shares, property, any other kinds of assets will end up paying more capital gains tax, and additionally more compliance to deal with, because you don't have to, if you have a capital gain below the allowance, you don't have to declare it, but a lot of people will now get caught by that. So that's not particularly good news. And the final change is that corporation tax increases are going to go ahead as previously planned. So we will see them rising to a maximum of 25%, currently from a low point of 19% over the next couple of years. So when you take that with the dividend tax changes, it may make those sort of GPs that are operating through some of their other income through limited companies, it may become less attractive to go down that route. So we can just move to the next slide, please. Just seem to have a problem moving slides. Yeah, great, thanks. One of the big things that will jump out from the budget, though, is impacting general practice is going to be the cost of employment. We're already seeing a period at the moment where the GP contract, which is tied into a 5-year deal through to 23-24, has seen a very small increment in the current year, and we'll probably only see a very small increment next year in terms of funding that's going into it. But against that, we've got a position of wage costs going up. And there's two aspects that came out of the autumn statement last year which are going to impact. Firstly, the freezing of the thresholds again has an impact in terms of employers' national insurance costs, because employers' national insurance thresholds are being frozen. So again, as staff pay goes up over the next few years, it will result in some more employers' national insurance being paid. Now, we're not talking huge sums here, but incremented over a number of staff, that's going to make a difference. But the other particular issue was the changes announced in the national living wage. The rates there are on the screen there, and actually for over 23-year-olds, we're seeing a rise from the current level of £9.50 up to £10.42, which is a 9.7% rise. Now, obviously, that's going to be welcomed from the individual's viewpoint. As we're going through a cost of living crisis, getting income to those that don't earn high levels is quite important. But actually, from a business perspective, that's going to be quite tricky for general practice, because as we know that quite a few members of staff are close to that national living wage at the moment, particularly in terms of reception, admin roles, and some healthcare assistant roles. So we're going to see the cost goes up, so that instantly anyone at the living wage level at the moment will need to get it increased, up by 9.7%. But of course, anyone who may be paid at the moment £10 an hour will also need to be increased. So you're going to see this kind of spike in inflation continuing in terms of wages, and practices are going to have to consider that and look at that in terms of what the cost is going to bring them. But as we're seeing in 22-23, having some quite difficult discussions with some of our GP practices in terms of cost increases, because they are largely unfunded at the moment. So we just move on to the next slide. Okay, so that was a bit about the autumn statement. The other thing that's coming in affecting tax is something called basis period reform, and going on from that, something called making tax digital. This is a change from the 6th of April 2024, potentially for those practices who don't currently have a 31st of March or 5th of April year end. Now, about 30% of our practices do not have a 31st of March or 5th of April year end. So we're not talking everyone, we're talking a smaller subset. And they've had a good reason to have a different year end from the tax year. But unfortunately, the rules are going to change going ahead, and 2024-25, every year after that point in time, you're going to have to account for your tax to the 31st of March or the 5th of April. So realistically, for a GP practice, 31st of March is the preferred date because it aligns with the end of the NHS year. You don't have to necessarily change your accounting date. You can carry on with, say, the 30th of June, but it's going to be really messy if you don't do that. And you're going to have people straddling two sets of accounts paying tax. So there makes little sense not to change your accounting date at the moment. So we anticipate that everyone will need to change their accounting date to the 31st of March. The transitional year for this is 23-24, and this is why I said it's almost upon us now. So in 23-24, practices with a non-March year end will have to do a normal set of accounts to their normal year end. So if it's June, for example, do a set of accounts to 30 June 23, but they will also then need to do a secondary set of accounts to 31 March 24, so a 9-month period in their case. And this sets out the transitional year for changing things. One of the downsides of changing to a March year end is that it does advance tax, which would be due potentially on retirement. Well, not potentially, would be due on retirement or when you leave the practice, just because historically you pay tax slightly in arrears with a non-March year end. So they are going to effectively advance that tax. Now, what they're going to allow you to do is spread that over 5 years, so long as you stay a partner within that practice for that period. At least some of the pain of doing this will be spread over a number of years, but it will result in more tax being due over that 5-year period, and practices will need to plan for that. There's also potentially a pension impact as well, because the pension rules, so for the pension rules for disclosing your pensionable earnings through the Type 1 forms, that automatically at the moment follows the tax rules. And whilst there is no guidance as yet as to what's going to happen with the pension, discussions at an early stage at the moment are indicating a further alignment with the tax rules. So not only will there be an advancement of tax, there may be a small advancement in terms of pension contributions as well. So it's not a particularly good news for those practices, because it will result in higher costs over this period. And there are cash flow implications of this. That said, it's a timing issue, because ultimately this amount would have been due at retirement or when you left the practice anyway. So it's really just bringing that forward. So we'll be talking to our non-March year ends over the next period to go through this. Also aligned with this, and one of the reasons for doing this is the government are bringing in something called Making Tax Digital. From April 2024, and that covers all self-employed people and all landlords who have buy-to-let properties as well, or rental properties. The rules under Making Tax Digital effectively means you have to keep your records in a digital format and be able to submit those to HMRC on a quarterly basis, so more frequently than you currently do. So we do need very much practices, and this includes our March year ends as well, to start considering their financial records and start to move to a digital platform in advance of the 6th of April 2024. To be fair, a lot of our practices have already moved to something called Zero. There are other products out there on the market, but it's going to cover landlords as well. So landlords will need to consider that as well. For those of you interested, we also are running a Zero webinar on the 7th of December as well, which is free for anyone that wants to join that. So yeah, some quite significant administration and tax issues coming there. If you just move to the next slide, please. In terms of the pension scheme, there have been some changes that have come in on the pension scheme side of things. So anyone who's been running payrolls in the last month will be aware that there have been some new pension tier rates in place for staff from the 1st of October 2022. So this has really narrowed the number of pension tiers that exist and the rates you are paying. But also we found that some rates have gone up and some have gone down, and particularly at the higher end they've gone down and at the lower end they've gone up. So some members of staff will be faced with slightly higher pension contributions going forward, and of course that brings an administrative hassle for you as practices. PCSC on the partner side, so PCSC are responsible for the partners and the salary GPs. They have begun to put that through automatically, so you're not required to update pension estimates for them. They have just used the pension estimates before, and they have adjusted the rates. So you may well have seen in your November statements, or when your November statements come out this month, that the pension contribution rates may have changed for some of your GPs, and that's probably predominantly just due to the pension tier being updated for them. In terms of the staff side of things, how it's assessed has been changed as well. Previously, it used to be on a whole-time equivalent basis. So if you had someone who was part-time, essentially you base the pension tier on their whole-time equivalent earnings. Now going ahead, it's going to be, in theory, more aligned to what they actually earn. So it will be based on actual earnings, which will therefore be better for part-time workers. One of the complications, though, that comes around that is people that are doing extra sessions or extra work, particularly as we see these sort of extended access coming into place at PCN level. It was raised with me, the practice manager yesterday raised with me this issue, in that actually if they're working extra sessions which are pensionable, then does that change the pension tier, which it could well do. So I think while trying to simplify this and trying to make it better for part-time workers, at the same time we've added another tier of complication in there. Just to advise you, there's going to be a further change next year as well. So they're going to change the pension tiers again next year, and that's likely to be the 1st of October 2023 at the moment. It's not been confirmed, but that's the date they are looking at the moment. And at the moment, there is currently no plans to change the employer rate that we are aware of. At the moment, there is a 14.38% contribution paid by the practice on behalf of its staff, and a further 6.3% top up by NHS England that goes off to the pensions agency. In Scotland, so our Scottish colleagues who deal with Scottish practices say it's completely different up there, and actually the practices pay 20.68% or the equivalent in Scotland. At the moment, we've not heard that the 6.3% is going to revert back to practices, although it could well do in the future. And just a final reminder on pension side of things, we are almost into the pension form season again. I understand from my colleagues across the country and talking to NHS pensions that the Type 1 pension form is coming out at the back end of this month, and will need to be submitted by the 28th of February next year. Likewise, Type 2 pension forms need to be submitted at similar time for salary GPs. As ever, we will guide you through that process for our clients. So just move on to the next slide. So this slide really just quickly highlights the pension tier changes that I referred to on the previous one. So you can see the tiers have changed. So the top tier now is at 13.5% for everyone above £72,031. And all the tiers have changed below that. And you can see the potential tiers for next year as well. So some change, some don't. So some will stay exactly the same, but you can see some go up, some go down. And it's at the bottom end of the salary range where they go up, unfortunately, and the top end where they come down, which is, I think, quite unfortunate given the current situation. Okay, next slide. So this is my last slide in the finance section, and it's just really worth just commenting generally on the current inflationary squeeze that is impacting general practice, as it's impacting a lot of businesses, but general practice in particular. We've already talked about wage costs being up. Not only have we got the minimum wage going up, but generally, we've got inflationary wage pressure at the moment. A 2% wage rise, which was planned in the original 5-year deal, really isn't cut it at the moment for a lot of staff. So we've got a lot of pressure on wages going up, particularly in the hospital sector, where it's gone up by 4.5%. If you've got people working in the community, it's quite difficult to trade off the two. Utility costs, as we're aware from home, the electricity, gas prices have gone up substantially. A lot of GP practices have fixed into deals, which is great news, but unfortunately, as the time goes on, those fixed deals will come to an end. The government have given some support until next April, but it's looking like the support they're going to give is going to reduce from the autumn statement. So practices do just need to bear in mind if you're on a fixed deal, that potentially you've got to be mindful when those fixes are coming to an end, because there will be cost increases. General costs are up. All suppliers, including the likes of ourselves, are not immune to the inflationary pressures as well. So you will see that across the board, your stationary supplies costs will go up, your medical consumable costs will go up. We're seeing, particularly in terms of drug supplies, the number of discounts available are coming down. So effectively, the cost practices pay are going up. So we've got a quite significant cost pressure increase going on at the moment. As I pointed out, the general practice contract is tied into a 5-year deal, and that runs till 31st of March 2024. So aligned with junior doctors who are also in a 5-year deal, the government's current stance is they aren't going to reopen these deals. They are going to make sure that the deals are complied with, which really means that you're looking at another global sum increase next year of probably around 3% only, and very little uplift in other forms of income. So we've got a situation where the income is going to be growing very small at small levels, and costs are going to go up, which is going to be difficult again. PCN's funding, as we talked about on our PCN webinar, PCN funding continues to grow, and it will have gone up in 22-23 and will go up further in 23-24. So at least that's a positive in terms of the PCN investment side is going to continue to grow. What that throws up, though, is really, really important that practices are making sure that PCNs are helping them and working for practices. A lot of the problems with PCNs is because it's around generating new levels of work for practices on PCNs to do, but PCNs really need to step up now and help practices out, because otherwise it's going to be difficult. And finally, we've got ICSs that came into being from the 1st of July this year, still going through a sort of transitional phase at the moment, but actually one of the issues ICSs have is they have a financial envelope to work in. And they can't go beyond that. And if you look at the financial status of a lot of our ICSs at the moment, a lot are running way over budget. Certainly in the where we're operating in the north of England, northwest of England, Lancashire, South Cumbria, the Manchester area, it's all running way over budget at the moment. And ICSs are going to be under pressure financially to bring those budgets back into line. The issue for general practice there is, whilst it doesn't affect your core contract funding, that will continue. Any funding that's coming through locally under LESs or local schemes, that now comes under the ICS domain. So it's going to be quite a difficult situation. ICSs are going to be pressurized financially, and if they don't reduce their costs, we'll be having to look what services to cut. And it's far easier, sadly, to cut things in the community than it is to cut them in hospitals, which have a very large fixed cost base. So all in all, not a particularly happy point to end on in my section. We've got a bit of a perfect storm ahead for general practice. Key issue here is you've got to keep your business under control. You really got to be on top of your financials at the moment, and potentially your partners need to be aware that if at some point you may well need to reduce drawings a little bit if some of these cost pressures do start to hit home. So I'll wrap up that session. We're going to deal with Q&As right at the end, and I'm going to hand over to Sarah, who's going to talk us through some of the legal issues ongoing at the moment.
Thanks, Andrew. So we are going to be looking at some of the common issues that we see in partnerships and how to potentially avoid them, hopefully. So what we'll start with is the admission of new partners. So the starting point here to know is that if the admission of a new partner is not documented, you could potentially be a partnership at will, no matter whether you've got a partnership agreement already. If it's not documented, then you are at risk of being a partnership at will. So new partners should be formally admitted, and that can be by way of a deed of admission or by new partnership agreement altogether. If it's at the stage where your partnership agreement's a bit outdated and you've got a new partner that you're taking on, it might be a good time to take stock and get a new partnership agreement altogether. If you've had one done fairly recently and you've got a new partner who's joined, then you can simply admit them by way of a deed of admission. And what that is just a formal document documenting the fact that they've joined the partnership, what terms they've joined on, what what their sessional commitment is, whether there are any specific terms that apply to them, and all of that will be documented in a deed, which sort of runs alongside the partnership agreement and just formally admits them into the partnership. We often get asked whether an offer letter is sufficient to admit them. It's good practice, but it's not a formal legal document. It's not the same as a deed of admission or updating your partnership agreement. So it is really important that you make sure that you get one of those two things done when you have a new partner join. So when you're looking at what terms the new partner is going to join on, you need to consider whether they're going to be a full equity partner or a fixed share partner. You might want to think about what capital contribution they need to contribute to the partnership. So whether there's going to be an agreed capital by way of reduction of drawings, or whether there'll be an initial injection into the partnership. You might also want to consider whether there'll be a mutual assessment period that they have to serve. It probably wouldn't be as common to do that where you're just promoting someone who's a salaried GP. If you already know the working relationship works really well, there might be no need for them to do a mutual assessment period. But if you're taking somebody on externally, it might be just good to document that there's a 6 or 12-month mutual assessment period, in which case during that period, if the relationship's not working out, either the new partner or the partnership can terminate the arrangement usually on 1 to 3 months notice. And you'll also want to think about documenting what the new partner's sessional commitment is going to be. That's particularly important in terms of whether your profit share is calculated by way of sessional commitment. So you're going to want to make sure that's documented either in the deed of admission or the new partnership agreement. And again, whether the new partner is going to join on full parity or not. It might be that you've agreed with the new partner that they will join on 80% parity for the first year, then 90%, and then 100%, and build it up that way. And you might want to document what's going to happen to the excess reserve of that parity as well. Go to the next slide, please. So I mentioned a partnership at will, and you can potentially be a partnership at will where the partner has been admitted without going down the proper route to the deed of admission. But really, some people say, well, what's so wrong with being a partnership at will? Does it really matter? Well, it does, in that a partnership at will means you're governed by very old legislation, which is from 1890, the Partnership Act. And it's not geared up to cover all of the things you'd expect to cover for a general practice. Some things that are particularly important to note, that if you are a partnership at will, every partner has the power to bind the partnership as a whole, whereas in a partnership agreement, you'd look to caveat certain things, certain decisions, which mean that each partner needs the permission of the other partners to go and do something. That might include sort of binding them financially or entering into any guarantees. You'd really want to look to caveat that and make sure that each partner can't just go off and bind the partnership into whatever they feel like, and really just add some protection there. With expulsion, there's no right for expulsion with a partnership at will. That can be problematic for obvious reasons. In a partnership agreement, you'd look to cover off expulsion and make sure those provisions are in tight so that you do have a right to expel a partner in certain circumstances. With retirement, no partner can retire without bringing the partnership to an end with a partnership at will. That's obviously a really key point that you want to avoid the partnership, because partners do come and go. You don't want to be in a situation where a partner retires and effectively brought the partnership to an end. And the same with dissolution. With a partnership at will, any partner has the right to dissolve the partnership at any time simply by serving notice to dissolve the partnership. And also death and bankruptcy will also trigger the automatic dissolution with a partnership at will. So in your partnership agreement, you'd want to look to cover those off, make sure that the partnership can't be dissolved simply by notice, and that the partnership will continue to run even after the death or bankruptcy of a partner. And again, with profits and capital, with a partnership at will, all partners share equally in the profits, losses and capital of the partnership, which we don't often see anymore when we draw up the partnership agreements. It is usually always by way of sessional commitment that the profits are split, and the capital contributions are usually different as well. So it's important to have that documented in your partnership agreement. And some other simple things with a partnership at will: the duties of partners, the obligations of partners, leave, whether that be holiday leave, sick leave, maternity leave, none of that is covered in the partnership at will. So again, when we draw a partnership agreement, we look to cover those off in quite a lot of detail, just for the reasons that it's simply laid out what the obligations and rights are of each partner, what the duties are. It just gives you a lot of clarity with what's expected of you and what rights you have in terms of leave. So we go to the next slide, please. So retirement provisions are something that we see quite a lot here in terms of coming to us for either advice on them, or whether there's been a problem with a partner retiring, or a partner who wishes to retire doesn't quite know what their rights are, or they want to retire on different terms that aren't covered in the agreement. So the starting point with retiring is to look at what your partnership agreement says. So we need to look at the notice period. And again, you'd want to consider how you serve notice, whether there's a specific reference to how it has to be served. You'd also want to have a look at whether your partnership agreement says that there's a specific limit on the number of partners that can retire either within an accounting period or within a holiday year. And so we often see that that's included to mitigate against last man standing. But you might just want to consider, if a partner has retired, how long it can be until the next partner retires, and think about succession. And again, with the partnership agreement, there might be options that are available to continuing partners, and that's in terms of buying out the outgoing partner. So it might be that the partnership agreement states that on the retirement of a partner, all of the other continuing partners have the option to purchase his or her share in the partnership and or premises, if that's relevant. And there might be specific notices within that time period which allow the continuing partners to exercise the option to purchase that share. And in terms of the continuing partners and the outgoing partner, you'd want to consider whether the partnership agreement has any specific restrictions on outgoing partners. And that might be going to work in a different practice within a certain radius, or setting up a similar business, or coaching staff, and again, letting patients know which practice they're going to. There might be specific restrictions on the outgoing partner, so it's worth just familiarising yourself with those provisions. So the important thing to note with retiring is, if you are retiring, or if you have a partner who is retiring at practice, if they're retiring on terms that are different from those that are in the partnership agreement, it's really important you get those terms documented in a deed of retirement. So we often get asked, do we need to do anything when a partner retires? Well, the simple answer is no, if they're retiring on those terms that are documented in the partnership agreement. If you've got a well-drafted partnership agreement, everything should be covered in that agreement, including sort of everything that applies with what happens after retirement in terms of leaving accounts and all of the things that go with outgoing partners. If it's well drafted, that will all be covered, and nothing needs to happen in terms of drawing up further documents. But if a partner is retiring on different terms, so say that there's a different time period that they're going to be paid their share of the leaving accounts, then you'd want to make sure that that's all documented in a separate deed, and that just gives both the partnership and the outgoing partner a bit of protection and clarity in terms of what's actually happening on their retirement. So is there anything else that you need? Yes, you will need to notify the NHS by contract variation notice, just to update who the partners of the partnership are. If we go to the next slide, please. So expulsion provisions, I mentioned that when you're a partnership at will, you're not covered by expulsion. There's no right to expel a partner. But when we draw up a partnership agreement for you, you'd expect there to be standard expulsion provisions. And that can be anything that you either ask us to put in, or we'll include a standard list. It would include things such as if the partner absents himself from the practice without good reason for a certain number of days. It could be if the partner becomes bankrupt, you may want the option to expel them. It's important to note that we're not saying that they will automatically be expelled when one of those circumstances happens, but it's giving you the option and sort of the backup and protection that if any of those circumstances happen, they may be expelled. The partnership has the right to expel you. And then the green socks clause, which we often get asked about, is optional to include in partnerships. So what is a green socks clause? Well, it is effectively a clause which states the partner can be expelled on no fault grounds. The reason it's called a green socks clause is effectively you can be expelled for wearing socks. So why would you want to include it in your partnership? So it is important that when you include a green socks clause, you may be thinking to use it against a specific partner in the future, but that clause can also be used against you. So it balances out the partners knowing that the clause can be enforced either way, where there might be significant personality clashes within the partnership. Can you rely on it legally? You can, except for two caveats. You can't rely on it where the partners have not acted in good faith when exercising it, and you can't rely on it where it's potentially risk of a discrimination claim which can be brought against the partnership where it has been used. So how you mitigate against those risks are, you could either look at making the expulsion clause subject to a process of reconciliation, which might mean you set out a certain process that when you want to exercise the green socks clause, you then go through a number of meetings and negotiations with seeing whether you can really actually not use the green socks clause and work out a way for the partnership to continue with that partner. And what we would say is before exercising a green socks clause, make sure you take legal advice, even if it's a small piece of advice on it. It's really important to make sure that you make sure you're not at risk of a discrimination claim, and that we can advise you whether it can be relied on legally. So yeah, it's super important that you get legal advice before exercising that. Next slide, please. So with outgoing partners, one of the key things that they get asked about is partnership assets. So it's really important to think about this when the partner's retiring and what assets the partnership has. So the main one we see is premises, where the premises is owned as a partnership asset. Often when a partner owns a share of the premises, they'll need to think about handing that back to the partnership, effectively being bought out by them. Other assets the partnership might have would be specific equipment, whether there's an expensive piece of equipment that's being bought for the partnership, could be medical, could be IT. It's important to make sure you've got all of those assets listed and you're aware of what they are. So in terms of what happens to the assets when a partnership retires, you need to think about them being valued if the partner owns a share of them, and how that value would come about, whether it would be market value. With the premises, you might want to speak to your surveyor and find out how it's valued. Again, you'd need to look at the partnership agreement to see whether there's something specific in there detailing how the premises or the specific partnership assets are valued. Next slide, please. And again, with the outgoing partners, I mentioned it previously, but the payment provisions are very important to have documented in your partnership agreement. So you'd want to consider how is it decided what the value of that payment's going to be. Well, obviously it would be by reference to leaving accounts. You might want to think about in your partnership agreement whether it's decided that you're going to wait till the end of year for the leaving accounts, or whether interim accounts will be drawn up. If you're getting interim accounts drawn up, make sure you clarify who's paying for those, whether there's going to be an extra cost. In terms of when you will receive the money as an outgoing partner, make sure that it's either in the partnership agreement or that you've agreed elsewhere in a deed of retirement when you will be paid out, what the time period for that will be, and again how that payment will be made, whether it be made in quarterly instalments or whether you'll receive a lump sum for that payment. Just make sure that all of the specifics that go along with that payment are documented, and that you can rely on them if there's any issues in the future. And again, with the premises, it might be that a new partner who's coming into the partnership is buying your share, or it might be that the continuing partners are buying you out in equal proportions. Again, it's just important to make sure that you are aware of how that's going to work and how you will receive the money for your share in the premises. Again, it comes back to the point, if there's anything above that I've discussed that is different to what's in your partnership agreement, make sure you get that drawn up in a deed of retirement. Next slide, please. So power of attorney clauses are particularly important in partnership agreements. So what are they and why do you need them in a partnership agreement? Well, for outgoing partners, the power of attorney clause is a clause appointing the continuing partners as their attorney to sign, execute and deliver on the outgoing partner's behalf all deeds and documents necessary for vesting in the continuing partners the benefit of the core clinical contract, assets, rights and benefits which are to be transferred to the continuing partners. So on a partner's retirement, it's very important that this clause is in here, just to make sure that everything can be smoothly transferred over. Anything that's in the name of the outgoing partner can be transferred over into the name of the continuing partners. And for accounting purposes, we usually include a power of attorney clause, which states that where accounts are approved by a partner but not signed, that partner will appoint each other partner as their attorney to sign, execute and deliver all deeds and documents on his behalf and do all things necessary to approve and sign the accounts. So it's just adding in that extra layer of protection there, where there might be a partner who hasn't been able to sign, just making sure that there's no dispute with the accounts, that all of the other partners have the right to sign on their behalf. Next slide, please. So the trust regulation rules update, which Andrew mentioned, there's been a lot of back and forth over recently. Just to give you a bit of background, under the trust regulation rules, there was previously no requirement to register trusts with no tax liability. However, the updated rules, HMRC, stated that they now require most express trusts to be registered, even those without a tax liability. So why is that relevant for partnerships? Well, some partnership assets are held by a couple or one partner on trust for the remaining partners. So we were worried that having that asset held on trust might mean that GP practices needed to register such trusts. However, recent update from HMRC has stated that GP practices are exempt from the need to register the trust, and for that reason being that they are considered public bodies under the Freedom of Information Act. So yet no need to register the trust, but GP practices are exempt. Next slide, please. I think that might be the end. It is, yes.
Yeah, so thanks very much, Sarah. We just got a couple of questions, actually, just on that that last point about the trust regulation side of things. I presume that also extends to PCNs, but given that the PCN contract's effectively a DES.
Yeah, they'd be considered a public body as well.
Okay.
Yeah.
Yeah, so that's useful because we had a lot of PCNs contacting us at the time around PCN bank accounts and joint things that were held jointly, but that looks like it's good that they'll be excluded now, which is good news. I've got a finance question. Someone's asked about the salary GP pay rise that came through of 4.5% recommended by the DGRB in July this year, and whether that uplift is covered by additional funding. Now, I mean, this also extends also to any staff that are under agenda for pay as well, because all the agenda for pay rates also went up by a similar amount of 4.5%. And actually thinking ahead, we've got a fairly large dispute about to happen with the nursing unions at the moment. If any changes that come out of that will also potentially impact on GP staff. If the government have to agree to a higher than 4.5% increase. The issue for general practice is there is no new funding. So if you've got a salary GP who is bound, whose contract refers to their pay award being aligned with the DDRB recommendation, then obviously you will need to pay them that extra amount, but there is no additional funding that comes in. And this is the problem at the moment for general practice. The funding is very restricted by that 5-year deal. So all that has really gone up at practice level this year has been the global sum. Even things like the items of service claims have remained exactly the same funding as the previous year. So that hasn't changed. Just a quick question on a partner leaving a practice. We're seeing at the moment a number of cases where the partnership value, the property valuations are particularly high at the moment, and with interest rates having gone up of recent, we're getting to scenarios really where financially the interest practices could be paying on new borrowing to buy partners out. Could exceed the rental income that they're getting at the moment. So one of the questions we have, has been raised is do you have to buy partners out of the property when they leave?
Again, I think you'd need to look at what the partnership agreement states. It would usually state, if it's sort of a recent one, that it's an option to buy them out rather than an obligation. Some of the older partnership agreements do state that it's an obligation. With the ones where it's an option, it's obviously an option either way. You can exercise it or not. Where it's not exercised, it's usually the case that the partnership agreement states that the partnership will be dissolved at that point and wound up. Where it's an obligation, it's a difficult one because it's obviously what the partnership agreement states. However, you can depart from the terms of the partnership agreement, provided that all partners agree to that depart. It'd be really one to either seek legal advice on where there's an obligation, or discuss really as the partnership what your options are. It might be that an option is for sale and lease back, or look at a takeover. There's a couple of options that you can look at where the liabilities become too onerous. But really, the starting point would be to look at what the partnership agreement says in terms of that buyout and whether it's an obligation or an option.
Okay. And just a further question about partnerships at will. So if you have you mentioned when you have a situation of a partnership at will, when someone leaves, effectively that brings that partnership to an end. Are there any implications on the GP contract that's held at that point in time?
Yeah, so it's often that we see that that's what the partnership at will states. In reality, it's probably not going to be. It depends on a number of factors, including sort of list size and whether it's actually feasible for that partnership to be brought to an end. In most cases, it's not going to be the case that it can just be brought to an end. What are they going to do with all of these patients? It would really be up to the discretion of the NHS to decide what to do in those instances. If it's simply a case of a partnership's joined, but it hasn't been documented, but all of the partners agree to that person joining, it may be the case that they're not a partnership at will. I think the important point to note really is that it's a risk to be aware of. It will depend on a case-by-case basis, but yeah, that they would need to consider a number of factors in terms of the contract. It would probably be unlikely that they'd have to put the contract out to bid somewhere else. It might just be a case of them giving sort of a number of directions to get the partnership agreement in place, so that the contract can continue.
Okay, great. I think that's the end of our questions, so thank you for those that posted them. Thank you again for joining our webinar today, and for those that joined the previous two. So this completes the third of our 3 series webinars with Mills and Reeve and Mazars together. Thanks to all the speakers that have come along. Hopefully you found that interesting. If you've got any feedback, please do not hesitate to get in contact with one of us. And for now, we wish you a good rest of the day.
Thank you very much.